The biggest property market conversation in Australia right now is negative gearing and capital gains tax changes. Everyone is talking about it because this could become one of the biggest shifts in the Australian property market in a very long time. If these proposed changes move forward, they could affect investors, property prices, rental supply, and even the way the entire market moves over the next few years. So what does the federal budget actually mean for property owners, buyers, investors, and renters? Let's break it down in simple language. One of the biggest debates after this budget is around possible reforms to negative gearing and capital gains tax concessions. For decades, these tax benefits have played a major role in Australia's investment property market. Many investors rely on negative gearing to offset property losses against income, while capital gains tax discounts have encouraged long-term property investment. But now, discussions around changing these policies have created uncertainty across the market. Some people believe changes could slow investor activity and reduce demand. Others argue it may improve affordability for first home buyers. But one thing is clear: if major changes happen, they could reshape investment strategies and influence how the Australian property market performs in the future. One of the biggest focuses of this budget is cost of living relief. The government is trying to reduce pressure on households while inflation slowly cools down. This could help create more confidence in the property market, especially if interest rates remain stable or potentially reduce later in the year. For buyers, that means borrowing conditions may slowly improve. First home buyers. The government has also expanded support for first home buyers. We're seeing continued focus on low deposit schemes, housing affordability programs, and incentives aimed at helping younger Australians enter the market faster. For many buyers struggling with rising rents, this could increase competition in affordable suburbs and growth corridors. A major part of the budget is increasing housing supply. The government plans to invest more into new housing construction and infrastructure to tackle the housing shortage Australia has been facing. But here's the challenge. Construction costs remain high, labor shortages still exist, and demand continues to outpace supply in many areas. So while more homes are planned, supply pressure may continue for some time. So what does this mean for property prices? In many parts of Australia, especially major cities and high-growth regional areas, strong migration and limited housing stock are continuing to support prices. We may not see massive price jumps everywhere, but quality properties in good locations are still attracting strong demand. The rental crisis also remains a huge issue. Vacancy rates are still low across many suburbs, and rents are staying high. For investors, that means rental demand is still strong. But for renters, affordability continues to be a major concern. So overall, this federal budget is trying to balance affordability, supply, and economic stability. But real estate remains very local. Some suburbs may grow strongly, while others may stay flat. That's why understanding your local market and having the right strategy is more important than ever. If you want to know how these budget changes could impact your suburb, your property value, or your buying plans, send me a message. Don't forget to follow for more Australian property market updates.